For momentum, statistically, it's one of the more resilient factors that's led to outperformance over time. So that's, just kind of a nice starting point in general. But we also find it's a good sign that things are going well at a company, right? So stocks hitting 52-week highs, it's hitting all-time highs. Someone is willing to pay more than they've either ever paid that year or they've ever paid ever for that company, and they're still expecting a reasonable return above and beyond that, right? So that we think there's signal in that on its own.
1, 2, 3, 4.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 8th episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by our second guest ever on the podcast, Ryan Modesto. Ryan is the Chief Executive Officer at 5i Research and the CEO and Portfolio Manager at I2I Capital Management. Prior to 5i Research and I2I, Ryan was with RBC Wealth Management. So with that said, Ryan, welcome to the show.
Thanks for having me. Number 2, feels like an honor.
Yeah, that's right. No, glad to have you here. And I'm sure we're going to have a great discussion today. So, 5i Research CEO, fund manager at I2I Capital. Can you give us a background into how you got here and kind of what the general timeline has looked like?
Yeah, it's I took probably a bit more of an unorthodox path than most people would take. So, coming out of go way back here, but coming out of high school, lived in a small town, didn't really know what finance was so much, so didn't have a whole lot of network or connections in that space or anything like that. Always knew I liked business, like the idea of business and building things and all that kind of stuff. So, but I didn't really realize, start to wrap my head around what like finance and investing was until second or third year of university. At that point, you sort of missed the boat on all of the, streaming yourself into the co-ops and the investment clubs and all that kind of stuff. So coming out of school, I just took some like my goal was always to get into kind of the wealth management industry in some form or fashion. So I just took whatever job I could get in the finance area. So it was like started out in kind of operation finance type of stuff, jumped into insurance, went into wealth management, and probably for like a 3-year period, I was just writing articles and research because in the background, I was always just investing my personal portfolio. I just love to do it. It's what I did in my pastime, kind of like doing research and all that kind of stuff. So I figured I would just write reports for myself to kind of, keep me honest or whatever in my personal process. But instead of just filing them away and doing nothing with it, I would try to send it out to different groups that would be willing to read it. Not sure anyone did, but I did find someone eventually who would read it. So for 3 years, I was just doing free research reports and articles, sending them off to this company called 5i Research and Canadian Money Saver. And after 3 years of them taking my free content and articles, they finally brought me on as a employee in the firm, and I kind of took some ownership in 5i Research, built it up over going on over a decade now. So I think maybe 11 years, sort of running the strategy, building that company, and still always having my eyes on kind of the wealth management side of things. So it's a kind of a long story short how we got there, but about 3.5 years ago, yeah, that's right, 3.5 years ago, we launched the I2I Long Short US Equity Fund, which is its own separate company through I2I Capital Management, and haven't looked back, focusing on small mid-cap US equities. And it's been an experience for sure. So launched right into I think we launched late 2020. So 2021 was good. 2022 was just that nasty market that everyone wants to forget. And the last couple of years have been pretty good. So can't complain.
Nice. Yeah, no, that sounds good. Thanks for sharing some details there. And I'm gonna have to dig up some of those old articles. I forgot they must be somewhere archived in our website. So
Yeah, definitely is.
that's great.
The
Yeah, and
one, the one.
then
I don't know why this one has a soft spot in my mind, but company doesn't exist anymore. But I think it was Viterra, and they did like grain silos essentially, and they sold and um, processed like grains, and they got, I don't know why this was like one of my babies or whatever though, but it got taken
yeah,
over by I don't know, some large agricultural company, but that was one of my favorite ones that I sent over.
nice. Yeah, yeah. It's the multi baggers that kind of stick around in your head, right? It's always the ones that the thesis plays out perfectly. Everything that you thought of kind of it just seems to make sense, and then it actually works out. So helps to kind of validate kind of your initial thought process.
Yeah. In
Um,
fairness, not sure that one was that great of. I think it worked out okay, but
yeah. Okay.
yeah, so
Yeah, fair enough. Definitely. And so you kind of mentioned this and alluded to this, but at I2I and 5i Research, there's a lot of focus on small caps, particularly growth stocks. What is it about small cap growth stocks that you kind of like, and why is that? Why is that the focus?
yeah, markets in general are pretty efficient, right? So with that in mind, if there's anywhere that there's going to be there's more likely to be some inefficiencies in the market, it's probably going to be the small and mid cap space. You have less eyes on each individual name. You have multiple more opportunities, right? So you have, let's just to frame it, it's Russell 2000 versus the S&P
Right.
500. Now, mind you, a lot of the names in the Russell 2000 aren't necessarily particularly investable, but you just the opportunity set you have in the smaller cap and the mid cap space is just multiples larger than large cap names, and by default, then you're just going to have less eyeballs on each name, right? Like I think if you have 5 analysts covering a smaller mid cap name, that's a fair amount of analysts to cover it, versus a larger cap name. I mean, they probably can have 30 to 40 analysts covering it, right? And so
Right.
if you're competing against that company that has 30 or 40 analysts covering it, like what kind of, plus all the other investors that are looking at it as well, what kind of edge or advantage are you going to have? Probably not a whole lot. Doesn't mean you can't make money in large caps, obviously, because I mean, just look at the last 10 years for the mega caps, right? But it's just I just think if you're going to position or going to try to set yourself up to outperform over time, small to mid caps is probably the space you want to be, at least from a odds point of view, probability, I guess. So, but
Yeah.
on top of that, you have some structural advantages too, right? So you have liquidity and transaction costs can be higher for smaller companies, so it's harder for the larger investors, larger funds to kind of take advantage of that. So you just get some more kind of inefficiencies on that side of thing. And I think for smaller companies, they're just positioned better to grow over time, just the advantage of their size, essentially, right? So say if you have whatever, the numbers don't really matter, but a $500 million company versus a $100 billion company, right? If that $500 million company gets a couple $1 million contracts or extra amount of revenue or whatever it is, that's going to move the needle for them, right? If you're that, whatever I say, $100 billion company, those $1 million contracts probably aren't going to do a whole lot for you. So they need to go and look at the $100 million contracts. But there's probably going to be less of those contracts available. They're probably going to be lower margin, and they're probably going to be more competitive because it's such a nice, big, juicy number kind of thing, right? So I just think the odds of a smaller company to find outsized growth opportunities are higher. And so they have more kind of chances at bat to get those, what would be a material contract to that smaller name compared to that larger company. So I just think the odds for outsized growth for a smaller company tends to be higher. Tech might be a bit different because you kind of get scale advantages and network advantages for larger companies, things like that. But in general, I just think your odds to find kind of the real nice growth companies over the long term are tilted more toward the small and the mid cap space.
Right. Yeah. No, it definitely makes a lot of sense. And, we see like a lot of these larger companies often have, bigger moats than what you would see at a smaller company. They likely have some more established kind of track record and a little bit more sustainability of some of the revenues. But when you can scale at a small size, or how you can ramp up at a small scale is, at a much higher degree than when you're a larger company. And so you can just see those multiples just jump a little bit more, whether it's daily percentage gains or compounding over the long term. So yeah,
Well,
no, it definitely makes sense. And
too, right? That's not even happening right now. So the
yeah,
mega,
yeah,
it's in the past, small and mid caps, smaller names have traded at a premium versus
right,
larger
right.
ones, right? But it's actually
Yeah,
reversed right now. And I mean these things come and go in waves, right? There's no rule that smalls need to trade cheaper or more expensive, whatever it is, kind of thing. But it is kind of
yeah,
interesting observation that typically you pay a bit more for a small mid cap name with the idea that their chances of growth are greater. But that's not what we've seen in the last couple of years for sure, and rightfully so. I mean, again, the mega caps have been fantastic performers, right? So they deserve
that's
that.
fair. Yeah,
But maybe that won't
yeah.
last. Who knows?
Yeah, no, it's true. Yeah, they've got big cash piles, but and that's been kind of helping them over the past few years with rising rates. But small caps being so interest rate sensitive in huge bull markets and periods where we have declining rates, these are names that are like highly sensitive to that, and they're going to see more upside potential. And I'm just thinking back to like the pandemic when March or April 2020 when Russell 2000 and every other index like really collapsed. I think the Russell 2K actually doubled from the bottom, which is like pretty insane when you think about it. Like that's an entire index of 2000 stocks that just doubled within 6 months or something. And so we saw, obviously a huge move in the S&P 500 and NASDAQ as well. But for the Russell 2000 to double, that's where the attractiveness kind of comes in for small caps too. Yeah. Not that we'll see a doubling of that index anytime soon. So,
nice, but
just a caveat. Yeah. Yeah. Cool. Okay. That sounds good. So yeah. So if you had a general framework that you use to select small cap growth stocks, can you kind of outline what that general framework might look like?
Yeah. So the primary way I create my screening universe is big surprise is running screens on a number of metrics that kind of resonate with our strategy. So typically what we're looking for is companies that have growth, momentum, quality characteristics, and we like shareholder yield as well. So we'll take those metrics and create a bunch of different types of quantitative screens that are filtering and looking for companies that have, whether it's a single one of those factors or kind of they kind of hit multiple of those factors or whatever it is. But we run 4 to 8 different screens that kind of look at these things that we like to see in companies. So that then is going to create a universe of stocks of about maybe 100 to 200 stocks that we just keep an eye on and monitor. But in that list, maybe there's 50 companies that would find their way into the portfolio at some point. So the 100 200 stocks, it sounds like a lot, but it whittles itself down pretty quickly. And over that time, when you build that initial list, you just kind of get aware of all the names that are in it, kind of understand what they're about. And then when you're sort of up to speed on those, you're really just waiting or watching for new companies that either pop into your screen or names that drop out. And it's pretty, so once a name comes into those new screens you have, you just do the work pretty quickly on it to understand what it's about. It doesn't mean you're going to add it necessarily, but new name you're familiar with. And it kind of creates like a snowball compounding effect, right? So now you're aware of these 100 names or so, and 50 of those are maybe investable at some point. Maybe one drops off your screens, but you still kind of have that embedded knowledge of it. So, maybe 6 months later, a year later, 2 years later, something happens in the company. Maybe they hit a new high and it jumps back in your screen because something big, just some material change happened at the business, or maybe some news event happens, and while it's not on your screen, you pay attention to that news event. You say, oh, I know this company. You can get back up to speed on it quickly, and maybe you make a decision or you don't on it. But you kind of get this compounding effect as your universe grows, and you get to turn over more and more rocks, right? And the more rocks you turn over, there's more opportunities, more opportunities at bat you have, I guess. So That's kind of how we build that universe, I guess. And then, but names that are kind of move up on the list or get high on the list are names that would appear on multiple screens. So, if we're switching screen to screen to screen of different kind of characteristics, and there's one name we notice that just keeps on popping up, and it keeps on popping up over like a 3 or 6 month period, then that really kind of the itch in the back of our head really starts scratching hard, right? And then we start to say, okay, like there's something going on here. We need to really take a very hard look at it if we haven't yet.
Interesting. Yeah.
Yeah, so that's the primary way of how we build the universe. But then on top of that, on like a weekly basis, probably my favorite Saturday morning routine. It's not gonna last long, I think, because the kids' hockey's starting up soon. But on a Saturday morning, I'd like to sit with a cup of coffee and just look at companies that have insider buying over the past week. And I mean, usually they're all like maybe 10% of the names you look at are would match kind of what we're looking for. But it's just another kind of way to get kind of new idea flow into our net, I guess. So
nice.
Yeah. And then on top of that, just scanning general news and developments. And like I said, kind of that compounding of knowledge sort of helps with that. Maybe some news release happens with a company you're familiar with, or you learn about their peers and competitors and suppliers and all that kind of stuff. So, at that point, we have our big list of our investable universe, if you want to call it that. And after that, it's good old fashioned fundamental research. It's consuming all the publicly available information. It's taking some time to understand how the stock trades, how it moves. What's a regular day, week, month look like. So, especially in small mid cap space, like names can move 5 or 10% in a single month, if not week, right? And if you're not if you don't understand that that's how it can trade, you're going to own something, and then all of a sudden it's going to be down 5 or 10%, or up 5 or 10%. You're gonna be like, wow, what's going on?
Feeling like you missed it a little bit.
Yeah. So you just have to you need to get familiar and comfortable with how a lot of these different names trade, and they all kind of do, not all, but a lot of them sort of do different things in different types of environments. But yeah, it's and then it's looking at the what their market size is like, what do their competitor suppliers look like, what's the management track record, are there other kind of signals you can find that might indicate what the demand of their other products or services are.
Nice. Yeah. No, I like the complementation of like looking at both those multiple screens as well as kind of doing that insider buying on the weekend. It just kind of adds an extra layer that you might see some name that's continuously popping up across all of those screens plus the insider buying. And then that's kind of like massive signal compared to one name just showing up on one screen randomly or point in time, something like that. So
it's funny.
That's really interesting. Yeah,
sometimes there might be a name that when it's on your screens, it's not really like you're kind of familiar with it, but it's not interesting you at the time. And then I'll be looking through insider buys and stuff like that, and then there'll be like a big insider purchase of this stock, and it's like, why do you recognize this name, kind of thing. And then you go back and you see it's actually in your screens, and so that's kind of interesting too. Like you do get, again, that kind of cross pollination across it all, kind of thing. I find the longer you do it, the more compounding, call it mental compounding, you get almost too. So
right. Yeah, no, that's fair. Yeah. And the more frequently you look at screens, the more that you're going to be seeing names and you're going to familiarize yourself with them, and then you're just going to have that larger kind of backlog of names that and kind of have this whole index. So it's a really good way of screening through stocks and finding that perfect balance of finding names. But you kind of mentioned like a few metrics that you look at when you're screening for stocks. Can you name some of the top few metrics that you look at when you're trying to pick a stock here?
Yeah. So, I mean, anyone that's probably listened to anything that myself or Peter have said over the years, it's momentum is one of our favorite metrics we look at. So for us, it's momentum and revenue growth are sort of the top tier things that we like in a stock or like in a company. For momentum, statistically, it's one of the more resilient factors that's led to outperformance over time. So that's just kind of a nice starting point in general. But we also find it's a good sign that things are going well at a company, right? So
Yeah.
stocks hitting 52-week highs, it's hitting all-time highs. Someone is willing to pay more than they've either ever paid that year or they've ever paid ever for that company, and they're still expecting a reasonable return above and beyond that, right? So that's that we think there's signal in that on its own. But
Hmm.
on top of that, typically if a company is hitting highs, usually it means something good is happening at the company, right? It means earnings are growing or revenue is growing or there's a shift in the valuation because something is changing, in their industry or just at the company itself. But something good is happening, and that's why it is hitting new highs. And so we always want to kind of look at why that's happening, right?
Yeah.
On on top of that, revenue growth is kind of the next main thing
Mm.
that we typically, I mean, never say never, but typically we always need to have the companies need to have good, consistent revenue growth on the top line. It is one of those things that if they can't grow the top line, why bother allocating your hard-earned dollars to that names? There's plenty of names,
Mm.
plenty of stocks and companies out there. Might
Yeah.
as well kind of tilt the odds of success in your favor by companies that can grow. And in general, good things happen when companies are growing, right? Even if they're closer, maybe losing a bit of money or closer to break even, if they can keep growing that top line, as long as the economics of the business makes sense, the earnings, they're probably going to get to positive earnings. So in general, just better things happen. Maybe your margins can increase as that revenue increases as well. You can invest more in research. You can invest more in your employees, whatever it is. But when your revenues are declining, the situation
Mm.
changes, right? Especially if you have some debt. If you have debt, you got to pay that down because those interest costs start to really cut in a lot more. You got to think more about maybe cutting back your workforce. You can't invest in the future. I mean, maybe you can invest in the future, but it's harder to invest in the future. It's harder to think long term when you have a declining level of revenues, right? So good
Yeah.
things happen when the top line's growing, but not great things happen, particularly when the top line isn't growing. So it just that revenue growth piece is something that's really important to us when we're investing.
Definitely. No, makes a lot of sense. It's, a company can't survive on profit margin expansion alone. So, you can only sustain so long with just margin expansion. So
Yeah.
eventually top line needs to grow. And whether that's, for large caps, it might be a smaller number, in the 5% range. But typically for small caps, we're probably looking at 10 to 15+% top line growth. Even higher, depending on the kind of name that you're looking at.
Yeah.
And
The
then it's a good point. Yeah.
Go ahead.
Sorry. Go ahead.
The importance is that the revenues are growing. Like you want high revenue growth, obviously, but you want consistent revenue growth over
Mm.
time, right? So, yeah, I'd far prefer a company that's going to grow 10 or 15% over the next 5 years versus a company that's going to grow 60% in 1 year
Right.
and go flat thereafter, kind of thing, right? So it's kind of you want that long runway of growth on top of the outsized growth as well.
Yeah. No, it's very true. It's like a numbers game where, 15% a year doesn't sound like much, but after a few 4 years, you catch up to that 50 to 60% 1 year growth rate just through the power of compounding, and it really starts to add up. So yeah. And on that momentum piece, yeah, it's a really good point. I love momentum for that reason, and just that, usually price is like the ultimate leading indicator. If something's moving up or down, there's usually a reason for it. And, if you kind of take a look into it hard enough, you can kind of dissect and figure out why. And then there's likely a reason or a narrative behind that move. So that helps a lot to explain it.
And people like winning stocks,
Yeah.
right?
Yeah.
So
Right.
then more people are looking at those companies, more capital's flowing into those companies, larger investors start to get involved, analysts start to get involved, all that kind of thing. So it really creates kind of a self-fulfilling prophecy in some cases as well.
Yeah. Yeah. No, it's a really good point. And then switching gears a little bit, so you're focused on small cap growth stocks, but I2I, the long short fund, is actually also focused on specifically US stocks. Is there any reason for that focus on US names?
Um, so love Canada. A lot of great companies in Canada in the public markets, no doubt. But the U.S. is just larger, more competitive. Has more opportunities from an investment perspective. It's home to some of the best companies in the world. So I just think that's like, why wouldn't you try to expose yourself to that set of opportunities? Honestly, it's
Yeah. Yeah.
and on top of that, a lot of Canadians tend to have a very large home bias to the Canadian market. So
Mm.
I'm sure you've seen the charts, but don't quote me on this, but it's something like the Canada's GDP is 3% of the global GDP out
Right.
there, but Canadian investors allocate like 60% plus of their assets to probably, I think it's
Mm.
higher than that, but over 60% of their portfolios to Canada, right? So you just get this mismatch of like what's actually going on in the world, and we have this this large, growing, one of the most robust economies just south of the border for us, right? So why wouldn't you kind of try to take care of that opportunity? So try
Yeah.
to
Yeah.
expose yourself to that opportunity. So that's kind of what we're trying to get at with the U.S. focus. And the other thing is too is the U.S. dollar actually acts as a nice natural hedge for Canadian investors, right? So
Hmm. Yeah.
because the U.S. dollar is a safe haven asset, when you have kind of a market panic type of scenario, assets flow into the U.S. dollar goes up. So yeah, your portfolio holdings are going down, whatever the market panic scenario is, but the U.S. dollar is kind of helping to offset that to some degree as well. So there's kind of a nice natural hedge in there as well.
Yeah, no, it's a really good point. I'm just pulling up a chart from 2022 because it reminded me. Yeah, in 2022, even though the markets, the broader markets declined as much as 30%, we actually saw the US dollar rise. I'm going to pull up kind of a rough amount here. It was about 10 to 15% in that year. And
Yeah.
so, an investor that's pretty much fully allocated to US stocks would have seen, almost a 15% offset on that 25 or 30% decline. So it really does help to act as a natural hedge, like you were saying. And yeah, another interesting aspect is just like how many products we use on a daily basis that are from the US, especially tech side. I mean, a lot of our daily workflow is really dependent on companies that are residing in the US. So
The
makes sense.
rebuttal you often get when you talk about home bias, so people say, well, my Canadian companies are 50% exposed to U.S. revenues or whatever it is. But I find it doesn't hold weight from like a portfolio perspective, because yeah, sure, you're getting U.S. revenues or whatever, but the Canadian companies trading on the TSX trade typically in line with the TSX to some degree, right? So
Mhm.
so say, if random example here, if TSX goes down 20%, but the S&P 500 goes up 20%, it's not like usually that Canadian company, even though they have 50% US revenues, they're not going to go up, they're not going to see that offsetting factor. They're going to go up they're going to go down in some similar fashion to the TSX that's gone down 20%, so
Yeah.
it's less about, call it, where the revenues are coming from, and more about sort of what that beta market exposure is in the portfolio. So it's from a fundamental point of view, yeah, sure, that company is going to be fine long term, kind of thing. But just because they have U.S. revenues, from a volatility point of view, it's not typically it's not going to help that company a whole lot, is what I've tended to find.
Yeah, no, definitely. And from other standpoints, I'm sure the US side kind of helps you out as well in terms of liquidity and other factors like that. And just the fact that the US stocks typically get like a premium valuation too. So that probably helps a lot as well. Okay, awesome. So, we've kind of talked about, small cap growth stocks, why US, your screening process, everything like that. So now that we kind of have the basis of what is in the portfolio, let's turn to portfolio construction. So how do you approach position sizing at, the individual level, I guess, individual stock position?
Stay tuned for part 2, where Ryan discusses his thoughts on portfolio construction, sector weightings, his outlook on the markets, and 2 small cap names that he likes right now.
1,